Hello student, welcome to the lecture on forfeiting and factoring. After this lecture, we will be able to learn the following objectives. Discuss the concept of factoring, define the mechanism of factoring, explain the export of factoring, describe the factoring services in India, understand the methods of financing international trade, explain the forfeiting services in India. Let's start with the concept of forfeiting and factoring. Forfeiting is a practice that allows exporters to sell their receivables to a third party known as a forfeiter. The exporter receives immediate funds to cover transaction, which limits risk and cleans up its account books. The importer can enter into a credit agreement with the forfeiter to get goods on credit and repay it over terms varying from 180 days to 5 years or more. This allows goods and services to move freely through the international supply chain. International trade can be tricky as all parties to transaction one guarantees that the other end will meet its obligation. One option is credit through a bank which pays exporters on behalf of the importer or which guarantees funds. Other options can include the use of escrow accounts and similar measures. Forfeiting is one among a library of options available to finance transactions that occur across international borders. The process starts with the sale of international transaction to the forfeiter. Forfeiters can ask to review the terms of transaction and the parties involved to determine if it is a reasonable risk. They take on the obligation on a no-resource basis, which means that if the importer does not pay, the forfeiter cannot turn to the exporter to make good on the transaction. This means that financial institutions need to be careful in forfeiting transactions to avoid exposing themselves to unnecessary risk. Forfeiting is very similar to factoring, where companies sell receivables to a third party at a discount to access immediate cash. The process of forfeiting, however, concerns export transactions specifically and does not apply to other kinds of accounts receivable. Some financial institutions offer both services to their clients along with other options for financing transactions and managing receivables balances. For large companies, having big outstanding receivables can create a financial liability. Investors and other companies may be unwilling to do business when a company owns a lot of money but does not have very much in hand because it is waiting on receivables. Let us now discuss the concept of factoring. Factoring goes by many names, including invoice discounting, receivables, factoring, and debtor financing. In simple terms, factoring is a practice whether one company purchases a debt or invoice from another company. It refers to the acquisition of accounts receivable which are discounted in order to allow the buyer to make a profit upon collection of monies owed. Factoring transfers ownership of such accounts to another party that then works vigorously to collect the debt. While factoring may allow the liable party to be relieved of the debt for less than the full amount, it is generally designed to be more beneficial to the factor or new owner and the seller of the account than to the debtor. The seller receives working capital while the buyer is able to make a profit by buying the account for substantially less than what it's worth and then collecting on it. Factoring allows a buyer to purchase such accounts for about 25% less than what they are actually worth.
Business owners, meet your neighbor, Fred. Fred owns the On the Rise Company, a rapidly growing company serving businesses across the country. Through his hard work, he's grown his small business from 1 employee working from his garage to 25 employees and a 10,000 square foot building. Fred still faces the normal day-to-day challenges of being a business owner. Despite all of Fred's hard work, perseverance, and determination, his growing business is lacking one thing: steady day-to-day cash flow to support payroll, taxes, supplier payments, and new orders. One thing Fred has plenty of is quality, slow-paying accounts receivables. Fred's experienced the financial challenges associated with growing a business and finding the necessary working capital to support its growing cash needs. Like many business owners, Fred tries the traditional channels to quickly bridge the cash flow gap. Fred quickly finds that today's banking requirements are more stringent than ever. Just some of the qualifications include a minimum time in business of 3 to 5 years, consistent operating profitability, strong personal guarantors, extra collateral, and a positive tangible net worth. Banks are a great option if you have the time to wait and are a well-qualified borrower. Friends and family can be a challenge for even the most prideful of people and can produce undesirable side effects. Often, friends and family simply don't have the resources needed to support a growing business working capital requirement. Investment groups and hedge funds thrive on distressed situations. More often than not, they demand a large percentage of the business for minimal investment and getting maximum control. As an entrepreneur, why would you want to go back and work for someone else? All along, Fred's had a timely, accessible, and reliable solution to solving his day-to-day cash flow problems, sitting right in front of him. Accounts Receivable Factoring provides Fred with immediate and unlimited access to working capital, so Fred can get on with running his business. It's accessible to startups and mature operating companies. Credit decisions are mostly based on the financial strength of your customers. And, unlike other forms of financing, factoring grows with your sales. Fred's heard about the many benefits of factoring from friends in casual conversation. Fred's also heard about some of the challenges that come with traditional factoring. Like every business owner, Fred's concerned about his most valuable asset, his reputation, and wants to preserve it. Personal relationships build Fred's business, and they are critically important to him. Fred wants to be more than simply a number. Traditional factors rely on old-fashioned methods to process, verify, and collect on invoices. Most factors have frequent one-on-one interaction with your customers. Antiquated phone and communications technology, combined with standard receivables collection practices, can be more costly to a business than simply the factoring discount. At Gateway Commercial Finance, we're entrepreneurs just like you. Our more than 60 years of experience has allowed us to create a unique factoring process that accomplishes our shared objectives. Our proprietary telephone technology and service methodology provides our clients with a nearly confidential factoring experience. We've invested heavily in state-of-the-art technology and our people to ensure your most valuable asset remains preserved. At Gateway Commercial Finance, like you, we value relationships. From your first call, you'll work directly with a decision maker. No salespeople, no credit committee, simply no strings. We'll take the time to listen to your story. We recognize that no two companies are the same, and no two stories are alike. With our industry-exclusive soft call receivables management, you'll never have to wonder how your customers are being treated. Checks remain payable to your company, and we rarely need to identify ourselves to your customers. At Gateway Commercial Finance, one-on-one relationships are important to us. Each of our relationship managers is assigned a maximum of 15 clients, so you get the attention and support your business deserves.
Difference between forfeiting and factoring. Forfeiting and factoring are two ways of financing exports of international goods through accounts receivables collection, distinguishable from each other by the type of export goods involved and the length of time the importer has to pay. Factoring deals with the sale of an exporter's accounts receivables on ordinary goods with the balance of payment terms due upon delivery or shortly thereafter. Forfeiting also deals with the sale of an exporter's accounts receivable, but only in regard to capital goods, commodities or other high-value export transaction and when the importer's period to complete payment is at least 6 months. Commercial banks and specialized financing firms have developed credit products that reduce the risk inherent in international trade and provide cash flow so exporters can be competitive in the global marketplace. Forfeiting and factoring are two types of international trade financing mechanisms that play an indispensable role in the viability of exporting. Ordinarily, once an exporter ships product to an importer, he has to wait until the goods are received before payment is processed. The payment is typically guaranteed by the importer's bank, but receipt of payment does not happen until after proof of delivery is presented. Both forfeiting and factoring are performed by banks or by specialty financing firms. The financing entity purchases the exporter's accounts receivables at a discount. This provides the exporter with his sales revenue immediately without having to wait for the importer to confirm delivery and provides the financing firm with a discount percentage as interest on the credit extension. Types of factoring services. The various types of factoring arrangement can be classified into the following categories. Full servicing factoring. This is also known as without resource factoring service. It is the most comprehensive type of factoring arrangement offering all types of services, namely finance, sales ledger administration, collection, debt protection, advisory services. The most important characteristic of this type of factoring service is that it gives protection against bad debts to the client. In other words, in case the customer fails to pay, the factor will absorb the losses arising from insolvency or bankruptcy of the client's customer. Resource factoring. In such a type of factoring arrangement, the factor provides all types of facilities except debt protection. That means, in other words, the client is responsible for any bad debts arising from insolvency of the client's customers. Maturity factoring. Under this type of factoring arrangement, except for providing finance or other facilities are provided to the client. As far as finance is concerned, the client is paid at the end of a predetermined date or maturity date, whether or not the customer have settled their dues in respect of credit sales. Terms and conditions of factoring contract. Factoring contract is like any other sale purchase agreement regulated under the law of contract. The terms and conditions on which factor agrees to purchase the debts from seller are mutually settled, keeping in view the business connections and customs. Nevertheless, some of the important aspects which are supposed to be borne in mind and incorporated in factor agreements are as follows. Offer to sell debts from time to time arising out of business transaction on such terms and conditions as are stipulated in the agreement. The offer shall specifically mention about the invoices relating to each debt as an evidence of the delivery of goods or rendering of services to the customer. Acceptance of the offer shall be comprehensive, covering all interest in the purchased debts, with all remedies for enforcing the debts and rights of unpaid seller being vested in the factor. Condition to have no recourse to the supplier by the factor in the case of non-recourse factoring contract on the failure of the customer to pay the dues. Power of attorney from the firm to the factor so as to empower the factor to the factor. Payment of purchase price of debts. Factoring. Advantages and disadvantages. Advantages of factoring. Under the factoring arrangement, the clients receive prepayment up to 80 to 90% of the invoice value immediately and the balance amount after the maturity period. This helps the client to improve cash flow position, which enables him to have better flexibility in managing working capital funds in an efficient and effective manner. Besides this, such arrangement also improves the ability of the client to develop sales to credit-worthy customers. If the client avails the services of the factor in respect of sales ledger factoring, forfeiting administration and collection of receivables, he need not have any administrative bill discounting set up for this purpose. Naturally, this will result into a substantial saving in time and cost of maintaining own sales ledger administration and collecting receivables from the customer. Thus, it will reduce administrative costs and time. As a result of this, the client can spare substantial time for improving the quality of production and tapping new business opportunities. Disadvantages of factoring. Image of the client may suffer as engaging a factoring agency is not considered a good sign of efficient management. Factoring may not be of much use where companies or agents have one-time sales with the customers. Mechanism of factoring. The client who is supplier or seller of goods and services, the customer who is a debtor or buyer of goods and services provided by the client, the factor who is a financial institution or intermediary between client and customer who provides a factoring services. Main characteristic of factoring services. The main characteristic of factoring are: factoring is a money market instrument, book debt represented by invoices are assigned in favor of a factor. Since factoring is not a negotiable instrument, customer's consent is required about the factor arrangement under which he will make a repayment directly to the factor but not to the client. Dual pricing structure comprising discount charges and services charges is followed.
Back in the day when you pulled into a gas station, you got more than just gas. You got full service attention. You got clean windshields and your oil and air checked. And if you needed a tire plugged or your oil changed or even a brake job, you could get that too. And all of it with no hassle and a smile. The full-service gas station may be almost gone, but at Advanced Business Capital, we believe in the full-service concept when it comes to invoice factoring and financial services for trucking companies. Many transportation factoring companies promise to deliver the type of financial services that make a true difference to a trucking business, but they don't always come through. We at Advanced Business Capital take a different approach. We actually do what we say. At ABC, you get competitive rates, fast funding, and, as a Triumph consolidated company, bedrock stability. Plus, you get a full range of services that no other factor offers. We call this full-service factoring. Hold on and pull over, okay? What is factoring anyway? Glad you asked. Factor is a math term that became a business term that evolved into an all-purpose term that has nothing to do with math. You with us so far? Well, to complicate things, factor is both a noun and a verb, which makes it hard to get a grip on. What's a factor? It's a business that factors. What's factoring? It's something factors do. Say what? Okay, you can see it's easy to fall into mystifying definitions, so let's demystify. Factoring is the sale of accounts receivable for a discounted price. Notice we said sale, not loan. It's easy to mistake factoring for lending because in practice, the relationship between a factor and its client is a lot like lender and borrower. There are, however, important differences. Here's an example. Tailgate Trucking is a young business, long on enterprise and short on capital. Tailgate handles a lot of loads, but its customers all pay in 30 to 90 days. Tailgate needs to pay for expenses like fuel and insurance a lot sooner. Sounds familiar, right? Tailgate's in a jam common to many trucking companies. It needs working capital, but it can't get a bank loan because its only real collateral are the trucks, which are already financed. Fortunately, so long as Tailgate has reliable customers, it also has a solution. Freight bill factoring.
Let us now know the meaning of export factoring. Export factoring services are offered to the exporters, clients who sell their products or services to the importers, customers in other countries on open account turn, having a credit period ranging from 60 to 180 days. Before the goods are shipped to the customer, export factor is expected to investigate the customer's creditworthiness and assume responsibility for collecting all amounts owed as well as affording credit protection. Export factor can offer benefits of export factoring both to the exporters as well as to the importers. The mechanism of export factoring is similar to that of domestic factoring, the exception being the exporter and importer belong to two different countries. 4 different types of arrangement are possible for export factoring. Two-factor system, single direct factoring system, direct export factoring, direct import factoring. The main function of the export factor relate to assessment of the financial strength of the exporter, prepayment to the exporter after proper documentation, regular audit and post-sanction control, need for export factoring. Many exporters find it difficult to evaluate creditworthiness of potential importers due to lack of information and data. Further, on account of various reasons, they also experience difficulties to recover dues from import customers on maturity dates. This poses the problem of credit risk. All these problems in respect of export trade can be solved by offering export factoring services to the exporters. Precaution to be taken by the export factor. If at all any organization intends to launch export factoring services, it must take, among others, following precautions. In view of the availability of export finance by banks at concessional rate to the exporters, export factor has to provide prepayment facility against purchase of export receivables under factoring services at competitive rates. For this purpose, factors have to mobilize funds at most affordable cost. Most of exporters may demand export factoring with or without recourse facility. Therefore, a factor must be in a position to offer this facility along with other services as a part of factoring services package. For this, he can take help of factoring company operating in importers countries known as import factor for absorbing credit risk. RBI guidelines for factoring services. The RBI has issued guidelines subject to which banks can undertake factoring services through departmentally. These guidelines are as under. Banks should frame an appropriate policy on factoring services with the approval of their boards. Though factoring services have been introduced since 1991 in India, still it is quite new in the sense that factoring product is not widely known in many parts of the country. Recognizing the utility of factoring services for small and medium-sized industrial and commercial enterprises in India for the first time, the Waghel Committee, which submitted its report on the money market, recommended the development of a system of factoring of open account sales, particularly for the small-scale industrial units. This committee further observed that both banks and non-bank financial institutions in the private sector should be encouraged to set up institutions for providing factoring services. Methods of financing international trade. International trade is a key factor in the prosperity of economies worldwide. Common financing methods that help facilitating trade between buyers and sellers across international borders include working capital financing, cash in advance, and open accounts. Each of these methods use a variety of trade finance products that are available to exporters to increase cash flow and reduce the risk associated with shipping products overseas. Exporters use different methods of financing international trade depending upon the resources they have available and the transactional risk they are able to absorb. The ability to access international markets is an important strategic opportunity for manufacturers and sellers because it expands a company's customer base exponentially. International trading is much more complicated than making domestic sales, however, and comes with internal and external stress factors that often determine whether a company can effectively operate in the global arena. The method an exporter uses for financing international trade depends on this stress factor. A company can only export goods if it can afford to manufacture them and wait for payment at some time in the future when the goods are delivered or sold on the importer's end. Also, a company can only enter the exporting business if it can find a way to absorb or defray the external risk of non-payment. The exporter may extend credit to the importer with the hope that payment will be made on delivery as agreed, or may require payment upfront, shifting the risk to the importer. Unfortunately, an exporter who requires importers to pay in advance may not be as competitive in the international marketplace as an exporter who can wait for payment.
Now is a make or break moment for all of us. In 1953, value of exports to UK GDP was around 10%. Now it is around 30%. This is a sign of how much the UK has opened up in international trade.
UK is still one of the top 10 exporters in the world. There are many things that UK excels in. Services is definitely one of them. It's sectors like banking, insurance, accounting, legal, education. These are all the sectors that we should be proud of.
UKTI's priorities are in the SME space. SMEs typically have more employment growth and more economic growth and more export growth, and we are determined to help them.
From my perspective, UK businesses has to take a bit more risk. Obviously, take the risk sensibly.
There is still, we believe, a funding problem, particularly for working capital. The banks are now more constrained than they have been. They have greater levels of regulation, and trade finance and export finance is not as attractive a product today as it was 5 or 6 years ago.
There is still a challenge with banking. I think we all know that, between the corporate sector and the banks. The corporate sector says the banks are not lending enough, particularly to SMEs, and we hear that every day of the week. And also government ministers are saying that they're not happy either. The banks are a critical part of the economy. There is nothing that we can do to get away from that, and collectively we have to try to solve that problem.
Generally, export demand seems to be increasing. There's a greater focus from UK government across the board on support to all categories of exporter.
In general, I think corporate treasurers are reasonably comfortable with their banks and are not necessarily in favour of the amount of bank bashing that is done politically.
I think the other thing that BEXA really does applaud is the change in foreign policy goals and really putting trade and export trade as central to foreign policy of this country, because that really does show the world that we're open for business, and for exporters to have that support top down is vital.
as we've heard from yourself and from Lord Poppert, it has taken a long time to get us into this position, and we're not going to get out of it overnight. But there is an absolute determination to do so.
Small, medium businesses were not getting an adequate share of bank finance, and I think that is largely due to their failure to use the facilities which have been offered by UKEF.
There are obviously challenges confronting the UK, but I do believe that there are a lot more opportunities out there if we work together.
Our country priorities are certainly the high growth markets of Brazil, Russia, India, China, but also other parts of Latin America, other parts of Asia as well. And we are determined to provide the support that small companies need.
I think, end of the day, all parties should have the same shared common vision, and that is to promote economic well-being for our people.
Features of a forfeiting arrangement. It is a specific form of export trade finance. Export receivables are discounted at a specific but fixed discount rate. Debt instruments most commonly used in forfeiting arrangement are a bill of exchange and a promissory note. Payment in respect of export receivables, which is further evidenced by bill of exchange or promissory notes, must be guaranteed by the importer's bank. The most usual form of guarantee attached to a forfeiting agreement. It is always without recourse to the seller, namely exporter. Full value of export receivable, that is 100% of the contract value, is taken into account. Normally, the export receivables carrying medium to long-term maturities are considered. Cost of forfeiting services. A forfeiting service is subjected to various costs such as commitment fee, discount rate and documentation fee. Of these, discount rate, which is fixed, forms a larger portion of cost of forfeiting service. The discount rate charged by the forfeiter is based on the following elements. A charge for the credit extended or finance provided. This is the main element and is roughly equivalent to the forfeiter's own cost of raising the money. A charge based on the risk of interest rate and exchange rate movements in the currency in which the credit is extended. A charge based on the sovereign risk, political risk and transfer risk, example, the probability of a change of government and imposition of exchange controls preventing the discharge of the debt. A charge based on the credit risk attached to the importer as well as avalor. Benefits of forfeiting services. The benefits accruing to the exporter are numerous. Few of these benefits are stated as: exporter can convert export transaction under deferred payment arrangement into a cash transaction. Thus, he can improve his own liquidity position. Since the forfeiter takes all risk, naturally exporter is relieved of the risk arising out of the default by the buyer importer, as also the political and exchange risk. Forfeiting services in India. Forfeiting services to Indian exporters. The RBI decided to make available such services to the exporters. At the beginning, the RBI authorized EXIM Bank in 1992 to offer forfeiting services. The role of the EXIM Bank has been that of a facilitator between the Indian exporter and the overseas. Forfeiting agency. Scheduled commercial banks have also been permitted to offer forfeiting services by acting as an agent or a facilitator between Indian exporter and the forfeiting agency operating in some other country. That means, in other words, scheduled commercial banks can undertake forfeiting services as a part of fee-based financial services. Now, in the end, let us summarize what we have learned in this lecture. Forfeiting is a practice that allows exporters to sell their receivables to a third party known as a forfeiter. Forfeiting and factoring are two ways of financing exports of international goods through accounts receivables collection, distinguishable from each other by the type of export goods involved and the length of time the importer has to pay. Under the factoring arrangement, the client receives a prepayment up to 80 to 90% of the invoice value immediately and the balance amount after the maturity period. The discount charge is levied on the advance provided by the factor and is computed on the basis of prime lending rate of banks plus premiums for credit risk basic. Bill financing is considered to be an appropriate form of financing traded under this form of financing. Seller of the goods draw a bill of exchange and the buyer who accepts and returns the same to the drawer. Forfeiting services to Indian exporters, the RBI decided to make available such services to the exporters. At the beginning, the RBI authorized EXIM Bank in 1992 to offer forfeiting services.